Hi, I'm Steve Chater with TCT Property Management Services, and we are the resource for people building financial security through real estate. And I want to thank you for coming and listening and being a part of our investor series. Today's conversation is about upgrading your investment so that you get better returns on investment. We're going to be talking about the ROI and the return on your investment. However, our goal is always the safe and secure way to create that financial freedom. We are not talking about taking undue risks. And so you've probably seen this in some of the other videos that we've done, and this is the spreadsheet that we have available for you. It's a spreadsheet that I use to track my net worth. And so you can see over on the left-hand side of the screen, the stuff that's in yellow. This is what you own. These are the assets that you have. And on the right-hand side of the screen, this is what you owe. These are the liabilities, the money that you owe to somebody else. And so when you're figuring out what your net worth is, you subtract what you owe from what you own, and you wind up down at the bottom there with the net, which in this case here is a little over $1 million. So as we look at this and we look and we say, okay, what's the return on investment that I'm getting from my current investments? One of the questions that we ask is, could I do better? Or could I do something different? Or how do I accelerate the growth of my net worth and my investments? And so as we've talked about in other videos, there are 5 advantages to real estate. 5 advantages. Number 1, you get appreciation, property goes up in value. Number 2, you get cash flow. It could be positive or negative, but we always recommend having a positive cash flow. You can use leverage, which means you can get a mortgage. You don't have to pay $300,000 for a house out of your own pocket. You can put up a down payment, use other people's money in order to acquire a $300,000 asset. Equity buildup. Your tenant pays off your mortgage for you, and because the tenant's paying down that mortgage for you, your equity is growing. And then of course, Uncle Sam gives most of the tax advantages to people that own real estate. So as we look at that, we say, okay, part of what we wrote in our book, Hold, is managing to the goal. In other words, I don't just buy something now and say, okay, good, I'm done. We say, okay, well, what's the goal for this one? So, and a quick story for me, I bought a property that I looked at, and the day that I bought it, I knew that that property was going to pay for my son's college education. And that was the goal. When he was 18 and I didn't need to sell that property in order for him to go to college, I wound up exchanging it into 3 other properties. So manage to the goal. What's the goal? All right. Well, what's the goal here? It's cash flow, number 1. It's net worth, growing the net worth. And number 3, it's freedom from a job, financial freedom from a job. So those are our goals. And how do we accelerate the accumulation so we get to the goal faster? Well, the return on investment makes a huge difference. So let's just pretend that you've got $15,000 and we're going to invest that $15,000 for 15 years. And the first thing we'll look at is, well, what if we put it in the bank and we got 2% interest on it? Which if you could get 2% at a bank right now, good for you. I don't think they're paying that high, but let's say, and after 15 years, your $50,000 would now be worth $67,000. Well, what if I get 8%, like I could probably get in the stock market if I stay safe with the stocks in the stock market? Well, now my $50,000 is worth more than 3 times as much. It's 1.6, or it's $160,000 almost. What about 15%? Because we can get 15% pretty much all day long in real estate. It's historical. Well, now my 50,000 grew to 400. Well, what about 20%? What about 25%? I'm over $1 million. My 50,000 grows to over $1 million. The return on investment, the ROI, makes such a huge difference. It's why we pay attention to it. It's why we're looking at it. So we had a client that had an older property. This is a picture of it. And in 2014, he sold that property for $220,000. The reason he sold the property was because there was better investment opportunities and he had lots of equity in it. But he didn't just sell it. He did a 1031 tax-deferred exchange. And because he used the tax-deferred exchange, he acquired 2 newer rentals. The first one up on the top is in Gilbert, and it was practically brand new. Beautiful home. The other one was in Chandler, and he's a fix-up guy. And he wanted a project. And so, but in both of these areas, he had a better chance for appreciation. He had lower vacancy factor because that's where people wanted to live. The rents were higher. The lower interest rate that he got gave him a 13% return on investment. Well, that's what we projected in 2014. Who knew the property was going to go up in value almost 10% per year every year since? So he's done way better than the 13 that we projected. The cash flow increased, the appreciation, like I said, and so he could have flipped this other property on the bottom of the page, and because when he fixed it up, he increased the property value, but he wound up getting higher rents, and so he accelerated his wealth accumulation by not having just one property, but having 2 properties that are doing it. Now, don't you all know that this is exactly how you play Monopoly? That you acquire one house and then another house and then another house. Why do you do that? Because you get to the point where you can get a hotel and you can win the game faster if you acquire more properties by increasing the cash flow. Now, what are some of the strategies to do this? Well, number 1, refinance your property to get lower payments, right? That's number 1. Number 2, you could take your positive cash flow that you have and accelerate the loan payoff. In other words, take the tenant's money that they're paying you and give it to the mortgage company so that you get out of debt more quickly. Number 3, you could purchase another property, free and clear. And actually, you could partner with your self-directed IRA so that you could come up with some money, your IRA could come, and you can own that property together. We'll talk more about that strategy in a different video. You can acquire some stock, which might have gone up in value or not, and turn it into an asset that's creating cash flow for you rather than just equity growth. So you see the name down at the bottom, that's my brother Marty. And Marty did that, and he was working for a number of startup companies, and they gave him stock in the company as part of the incentive to go to work for them. And so he came to me and he said, "Hey Steve, can I want to buy some real estate because as I'm looking for retirement, the stock doesn't pay me dividends, and so I want to be able to create cash flow." Well, this is a house in Gilbert, Arizona. Then he purchased in order to create that retirement income, and he wanted to use a loan on it so that the tenant would pay it off for him. At the same time, the amount of money that he had, he said, "I want to also use a loan so I can buy 2 rather than just 1. So in doing that at TCT, what we do is we take a look at the market and we say, well, where's the best place to go? And this is when he was looking to buy. And everybody was buying in this town in Arizona called Surprise. Why? The price was low. But the thing is, all the investors are buying, so there's lots of properties available for rent, and there's a 2.5-month supply of homes. So while the prices were cheap, you're going to have more vacancy factor on it, and it didn't make sense. Then we took a look at Gilbert, and the house that I just showed you is the house he bought in Gilbert. There was less than a 1-month supply at that time. Now, today, it's way less than a 1-month supply. It's hard to find rental properties, and he's doing extremely well with that particular investment. But even when we projected out, and you see the 2% up there, we projected that his property was going to grow at 2% in appreciation. It's been going up at almost 10% per year. Now, I don't think that's going to continue, but it's still going to go up at 3, 4, 5% per year. And just with a very conservative projection where he put 50% down on that property, because remember, he wanted cash flow, he was making 14.5% projected. He's done way better than that at that point. So let's talk about one more thing in increasing the cash flow, and I'm talking about renovation rewards. You know, lots of people don't want to fix up their property because they, oh, it's just a rental property, and it's not, you know, I don't want to put money into the rental property. So here's an investment property. And this was one of the properties that we managed for a doctor, and he was having it rented for $1,200 a month. The property at the time was valued for $225,000. And he said, what should we do with this property? And basically he didn't want it anymore because $1,200 wasn't much for this surgeon. But I said to him, you know what, if you want to go ahead and make some changes to the property and fix it up, not only could we get you more rent for the property, but we're also going to get you more money for the property if you decide to sell. So he said, okay, let's remodel the kitchen. And he said, let's do the baths too, because those are the important rooms. He set a budget of $27,000. We painted the cabinets instead of replacing them. We replaced the light fixtures with newer, more modern. We replaced the carpet, the plumbing fixtures, and replaced all of the window coverings in it. Here's what wound up happening. Here's this return on investment. The new value went from $225,000 up to around $275 to $280, double the cost of the renovation that he put in. So he doubled his money on that. Okay, he invested $27,000, get 50 grand more in equity. Number two, the new rent was now $1,800 a month, not $1,200. That's $545 more. So let's just take a look at this. $545 times 12 months equals $6,540. If you divide that by the number 27,000, the amount that he put in, that's a 24% return on investment. You realize he could have borrowed money on the credit card to pay for that and make money on it, even paying credit card interest. It was a huge way to increase the value and increase and accelerate his growth in net worth. So, what are the things that we bring to the table? Because we are the resource for people building wealth and building financial security and building financial independence with real estate. First of all, we provide that kind of in-depth research and analysis that I showed you with my brother's property, that I showed you with the doctor's property, okay? And we'll do that for you so that you can make the best decisions. Even using your real estate agent, we don't buy and sell houses. We're just an advisor for you in the investments that you do. We've done it for over 40 years. We've always find great residents for your property, and we will save you money and hassle on getting any of the repairs taken care of. So I want to thank you for watching this video. I want to thank you for being a part of TCT and part of the TCT family. Our goal is to help you continue to build wealth and financial security with real estate. And be sure to check out all of our other videos that we've got on YouTube. We're happy you're here. We're happy we're here to serve you. And so thank you once again.